how do you position for possible inflation that isn't necessarily quickly transitory?
Well, that is the question, right? We've known for a while that inflation was going to be higher than expected for longer than expected, and this is just another layer that is going to extend the rise in inflation. Now, this does seem to be rather transitory in terms of the energy crisis, but you still want to look at it. So, there's some areas of the market like energy that are benefiting. We've talked about energy, we've talked about material for a number of months already. So that's one area to look at. We've kept an eye on break-evens, of course. One of the better ways of having a little bit of a hedge for the bond side of your portfolio. But beyond that, I think it's just trying to look through some of the noise, some of these reactions, and just thinking through to what the growth outlook is going to be like, how different governments and central banks are going to react, and try to stay positioned as long as that outlook doesn't materially change.
How long do you think that's going to be? Maybe this is transitory, but we throw the word transitory around all the time. It's not defined. Transitory can last a while, and I'm wondering at what point investors are going to say, actually, yeah, maybe it's going to be something that we have to live with for a while. This may just be this winter when it comes to energy, but shortages of delivery drivers, shortages of materials, they feel much more permanent at this point. Certainly judging by sort of my own personal anecdotal experience, trying to talk to companies about when stuff is going to be available.
It is a concern, and obviously transitory is a number of months turning into quarters and not a question of the very short term. I do think that the zero COVID policy that we've seen across most of Asia has exacerbated some of these supply chain shortages. So as we continue to move on from the pandemic, these should start to ease and we should have an improvement. We also saw a much quicker rebound and recovery in terms of the global economy, and businesses just weren't prepared given how deep in the pandemic we were before that. So a number of different areas that, the factors that are weighing in here. I think we do have to be prepared for this to last a little bit longer. But I'm not sure it really changes the growth outlook that much, which I think has actually been stronger than expected. And the recent economic data has shown that as well. And that means that the market picture in terms of equities and risk assets stays quite constructive.
Is that because the consumer demand and household balance sheets are still so good? Or is it because the supply shortage is indicative of sort of more consistent, stronger demand? What gives you that confidence?
It's a combination of both, but when you look at the trillions in excess savings in the US, when you see that we probably are going to end up with something between 2 and 3 trillion of additional spending, now obviously over 8 to 10 years, not on the scale as what we saw during the pandemic, but when you combine the bipartisan and the reconciliation infrastructure packages, we're going to have some support there. And we're seeing ongoing underlying consumer demand. So it's difficult to imagine a very negative growth scenario when you have so much cash and so much will to spend.
What is your attitude and what do you tell clients about having government bonds in their portfolio? If this transitory phase of inflation lasts a little longer than we expected, we are going to continue to find ourselves in a situation where these bonds just continue to make losses after losses after losses. It's been something that investors have had to deal with for a while, but it feels particularly kind of germane at the moment to talk about it, given the fact that we do have inflation spiking higher, the yields are picking up, but they're way below where inflation is.
Absolutely. And I think this is going to be a question for the next 5 or 10 years, right? When you have such low yields as a starting point, what do you do with your bond allocation? And for institutional investors where bond holdings are a bigger portion is going to be an even bigger conversation. I think some of it depends on how overweight or underweight you've been and for how long, how much pain you've taken already. It's difficult to not have any at all. But at the same time, if you're thinking within an asset allocation, it's clearly the asset that you want to be underweight in, and then probably favor credit or short duration credit to get the yield pickup instead.
Mm-hmm. Quick question before we go. Everyone's always still talking about going into the value trade. If you go value, you got to go into Europe. How sticky do you think that is?
I think we've seen the bulk of the catch up for now, at least. As I said, I think if inflation stays higher and growth stays stronger, it means it can continue. But we probably don't see the strength of this reflation trade like we saw at the end of last year after the vaccine announcements. But I do think there's a bit more to run.